Welcome to Subramani. I'm going to talk to you like as though I'm talking about the basics of equity investing, but such videos are useful for everybody once in a while. So let us understand what is the situation we are in now. Markets are volatile, but markets have always been volatile. 100 years, 150 years, 200 years, whenever you see data, you will find that markets are volatile. Similarly, even any commodity price, anything that you see, markets have been volatile. So there is no question of saying markets are volatile. Markets have always been volatile. If you look at the data, financial data of Indian companies or even maybe foreign companies, a lot of deleveraging has happened. So companies are in a position, even your big metal companies and automobile companies have deleveraged quite a bit, and there is scope for them to borrow. But it is also possible that we think there is scope to borrow because interest rates are low. When interest rates go up, you don't feel like borrowing. That gut feel saying, oh my god, interest rates are up, I should not borrow, it's a corporate as much as it hits an individual. So people may not want to borrow, but it may be a good time to be borrowing and putting up plants, etc. We do not know when that will happen, but we also have to understand one thing, that corrections are common. So market falling 3%, 5%, 7% is a regular phenomena. If you take data over the last say 10 years, definitely there will be lot of 5% falls, lot of 6% falls, 7% falls. You are really hit when there is a 20% fall and say, oh my god, it's a bear market, or a 10% fall and you say, oh, this is a correction, right? Those numbers hit only when the numbers become big, they hit. But then you have to keep on looking at your portfolio and seeing whether the fundamentals of the company are strong, whether the company has been able to reduce debt. Look at a power company which is reduced debt. Not that I am recommending, but any company which keeps reducing debt, it means it has got enough cash flows, it has got enough pricing power, right? You have to have pricing power to have good profitability. So if you take a company like Tata Power, the main aim was to reduce the debt, and they have dramatically reduced debt, right? So if they have reduced debt, it means next year the earnings will improve because interest rates are also lower and people must be dying to give them money. So right, so which means I mean, you go back to saying, okay, the fundamentals of the company are good. I'm not saying that it's a good buy at 220 or 230, but remember, for many companies the fundamentals have improved, the market numbers have increased, the number of cars that you sell have increased, the number of I mean, I can imagine whenever I go and see an Indigo flight, I see it full. Yes, occasionally I don't see it so full. I do think that from March people will act with a vengeance towards travel and tourism. I'm personally doing a session in the month of February in Bombay. I'm very happy that I'm doing it in Taj Lands End, and I'm not doing it from a video at home like the one which I'm doing, because it's not interactive, right? So, but these things are happening. So stocks look good, stocks look bad, right? Quoting Charles Dickens, good times, bad times, both are there. So there are companies which I feel are very attractively priced, and there are companies which I don't think I'll touch with a barge pole. There are many companies which I've sold, many companies which have. Look at the oil marketing companies. Obviously, the UP election meant that the prices couldn't be raised, and therefore the prices have come down. It does not take rocket science. But if it comes down much further, maybe that will be a good buy. Or if the oil prices come down, then it will again be a good price. Shale oil in US will have an impact. So understanding that there are so many factors at play, and considering that everybody likes a bull market, so you hear more bullish noises than you hear bearish voices. So you have to manage the two. You have to manage the noises as well as manage the fundamentals and managing your sentiments, right? Ultimately, how much money you make in your portfolio is all the three. How much you think about risk and how much you spend time on managing risk are two different things. Just keeping on saying, oh, markets are risky, but being in equity is not a right thing. But saying that the markets are risky, therefore I will shift to a more value portfolio which has got higher dividend, where I don't think the EPS is going to fall too much. That is acting on the risk. Acting on the risk is far more important than saying, oh, I knew the market will fall. But if you knew but you didn't act, or if you didn't know, the impact on your portfolio is the same, right? So just check out. Sometimes bond looks better, sometimes equity looks better. So check out your asset allocation, see what is happening. As of now, it looks like shares are better than bonds, but not enough bonds are available in India anyway. So you will have to go and invest in mutual funds, and then therefore I would still stay at the shorter end, but I do put money on an SIP basis in the longer end of the curve also, because, and also understand the Fed has absolutely no control over the longer end of the curve. It is only, they fool around only with the shorter end, right? So what all do you have to do? I would think you should decide that, okay, I will also be in high growth companies, because these are the companies which are going to give me dividends 10 years later. But I will also have value funds, because when the market falls, the value funds will fall less than the growth fund. So today I have, say, growth fund and value fund, but it is a time perhaps to have more value and less growth, right? So if you have 50-50, maybe you go to 40 in growth and 60 in value, maybe, if it suits you. I have anyway done that, but I have a large portfolio which is very dividend driven. So to that extent, my Coal India and all don't go out of my portfolio very easily. I collect the dividends for a long period of time. So I may not sell that, but yes, I have sold the oil marketing companies because of the government's inability to increase oil prices during an election. And in this country, we will have an election every year. We have some election happening somewhere, so, right? So pricing power is a problem for oil marketing companies, and that is visible in the price drop that has happened. So you have to manage you have to see how much you want to be chasing growth, how much you want to be chasing dividends. So and similarly in the bond market, you want to know how much money should be in the longer end, knowing fully well that if interest rate goes up, you will take a hit there. So understanding MTM, understanding and then being there is called managing risk. So you could do that. One thing which you should not be doing is to say, oh, interest rates are very low, let me compromise on the quality, because absolutely shitty paper is going around at 9.5%, and when I look at some of those promoters, I would want 14, not even 11. So don't compromise on quality, stick to 6-7% good quality paper that is available, 7.15 if you have RBI bonds available. Until somebody gives you 11%, it is not worth it. 9.25, 9.15 are all not worth it. Be very careful, extremely careful about quality, because a lot of junk will fly, right? So you have to decide whether it is junk or whether it is good. It will hit upper circuit, it will hit lower circuit, there will be a rumor that they have repaid debt, there will be a rumor that they have changed hands. You will receive a lot of such things. Now if you don't understand, stay away. If you understand, do proper research and then take action, right? I am not too keen. I personally don't touch shares which don't have too much of a good track record or does not have a good promoter. I'm very scared about compromising on quality, and so should you be, right? Just because growth has performed well, it does not mean all your money should be in growth. Like I said, you should have a combination of growth, value, gold, and debt, right? So you decide whether you want to be 80% in equity or 30% in equity. That's your call. But within equity, also be very careful whether you're having large cap, mid cap, small cap, value, growth. Be very careful about all those things. You will have to do some kind of managing will definitely happen. So be careful about that. Let me summarize by saying that 2020 was an exceptionally terrible year from a volatility point of view. Market really hit real lows, and people would call me and say, I think it's the end of the world and nothing is going to happen. This is the worst thing that could have happened. 2021 told you that yes, 2020 saw the pits and 2021 saw the peaks, right? 2022 is more likely to be normal, but I really don't know what is the normal, simply because the Fed could behave very differently when it increases interest rates and it does not see a great response. It might reduce interest rates. So be very careful. Don't trust the Fed to do what you think it will do. Fed, of course, has its own mind. It will do what it thinks is right. It could keep increasing interest rates and the US market could boom. If the US booms, because even when the interest rates are going up, it means all the service providers, technology companies will boom. right? And the US dollar rate will, the dollar will get stronger. Let's say the dollar goes to 81 or 82, then the investments that you have in US will anyway do well simply because of the change in the interest rates. And also understand that since we have seen a longish bull run for last 12 years, we could see a 3-year, 4-year recession also, simply because you would then have to sit down and calculate and feel, oh, the market gave us all the returns upfront and so there is nothing back-ended, right? So in a 10-year period, if you analyze, it's possible that 2 years markets do very well and then 8 years market doesn't do anything. So these kind of 10-year cycles have been seen. Or first year it does very well, second year it does very, very badly, third year it does worse than that. I mean, in terms of the market comes down dramatically, and then it just zooms and stays zoomed over the next 8 years, 9 years. So all these things have happened. We are complacent because we don't think that the market will go down, or we have been blinded by the industry and the media saying, oh, markets will go down, but don't worry, we are a great country, 2% of our population was investing, now it is 2.5, and this 2.5 becomes 5, or market cap will double, triple, our GDP will reach 5 trillion very soon. All optimistic things. Please take it with a shovel full of salt, because a spoon may not be enough. Thank you.